Alexander Tyler said a democracy cannot exist as a permanent form of government. It can only exist until the voters discover that they can vote for themselves largesse from the public treasury. From that moment on, the majority always votes for the candidates promising the most benefits from the public treasury, with the result that a democracy always collapses over lousy fiscal policy, always followed by a dictatorship. The average of the world's great civilizations before they decline has been 200 years. These nations have progressed in this sequence: from bondage to spiritual faith, from faith to great courage, from courage to liberty, from liberty to abundance, from abundance to selfishness, from selfishness to complacency, from complacency to apathy, from apathy to dependency, from dependency back again to bondage. Remember that the closer we are to dependency and bondage, the closer we are to spiritual faith and great courage. The cycle starts all over again. The theme this year, The Fuse is Lit, was chosen because there are critical external issues both in Europe and in Asia, which will pressure the dollar and U.S. Treasury markets. These we've discussed in Part 1 and 2. There are also a number of internal issues that bear on the U.S. dollar and debt markets as well. We believe the fuse is already lit, and the events ahead will include not only financial and economic chaos, but social and political upheaval as well. We'll consider three things: the making of American poverty, a post-election synthesis, what 2013 to 2016 holds for us, and what we can do now. Let's start with price stability, or inflation. 2013 represents the 100-year anniversary of the Federal Reserve System. And worthy of note, in that time frame, we've lost nearly 100% of the dollar's purchasing power. The original mandate of controlling the supply of money in order to maintain price stability stands in the light of history as a failed mandate. And the item that cost $1 then, 1913, today costs $20. 95% of our purchasing power has been knowingly destroyed. And as incomes have risen with the tide of inflation, the majority of people have entered into the progressive tax scheme with a greater flow of dollars than ever before, going to feed the leviathan known as government, which knows no limits. Born out of crisis, the Federal Reserve, it was hoped, could prevent financial crisis. Today it perpetuates crisis and reinforces systemic vulnerabilities through never-ending credit creation and price controls via what is called ZIRP, or zero interest rate policy. Then there's income tax. Imposed in 1862 to help fund the Union War effort, it was eliminated 10 years later. Then reintroduced in 1894 as a flat tax, 2% on incomes over $4,000, which didn't affect even 10% of the population. But it was stricken down by the Supreme Court as unconstitutional the next year. The problem was the tax was applied to dividends, interest, and rent, and was not, quote, apportioned by population, and as such was a direct tax on property, and thereby unconstitutional. Then in 1913, the same year, we ventured into the known perils of an actively managed currency system with a central bank, the Fed, the third attempt, remember. We launched a permanent and progressive tax on income, legitimized by the ratification of the 16th Amendment to the Constitution. Now it is constitutional, in contrast to the 1895 Supreme Court decision. The top marginal rate at that time was 7% and has grown in lockstep with the political class's ambitions to increase governmental control and influence in all social and economic arenas. There's a fundamental problem with the ambitions of politicians, and if not reversed, will ultimately bankrupt this country, if it hasn't already. Overreach, or the inflated view of the importance of regulation and control, this political interference in all areas of life, is crowding out the role of citizens as self-governing people. A long time ago, we asked to be represented, but not ruled. Recall that this was the basis for the revolt from England. 1, we had no representative voice, and 2, we were required to support the largesse of the state, with the benefit going to those who were tied to the British American political class. Today, our tax structure supports the American political class, and via promises from the Federal Treasury, allows them to buy votes. The third factor in the making of American poverty is politics. What we lost in the election, we've lost in every election going back to the 1950s. That is, government accountability in spending. 1954 was the last year in which government spending went down. The American people continue to lose ground to a growing political class that takes in more and more revenue and spends more towards pet projects and constituency-driven promises with every year that passes. Since World War II, the budget has been completely politicized. In other words, in an age of universal suffrage, for which we're very grateful, politicians have figured out how to redirect money from the public treasury to pay for votes. Of course, people do vote their self-interest. The tragedy is that nearly half the population has no skin in the game and therefore has nothing to lose and everything to gain via their ballot. This age is one of whitewashed corruption. The public says and does nothing to address our rampant corruption, in part because they're complicit, being at the receiving end of the tax redistribution scheme. Lest we lose hope in our fellow Americans, do recall the Rasmussen polls from July 2010, showing 65% of the country thinks we'd be better off if all incumbent members of Congress were defeated. Then again, January 2011, Rasmussen showed that by a 3-to-1 margin, the American people believe that no matter how bad something is, Congress can always make it worse. There is still a core of common sense and pragmatism in the American public. Personal political legacy is the curse of our day, exemplified by career politicians versus the more desirable citizen statesmen willing to serve but only a short term so as to return and tend to family and community and work. Politicians today are not people whose lives are on hold while they serve a short stint in civil service. No, that is their life. Carving up positions of permanent power, like anyone in a private business knows from encountering office politics. The jockeying for positions of power, influence, control, and permanent place are drawn from the template in the public sector. The movement in politics has been away from them, our representatives, working for us, and more towards us working for them. Representing the will of the people as a job description is something disdainfully regarded by our political class as an intellectual misunderstanding. Amongst the political elite today, you'll find the belief that the people do not know what they need. The people do not govern themselves. The people need the benevolent hand of better informed, technically skilled elites. It's as if we are back in 1775, where the political class operates without regard or respect for the people. There's 3 primary areas which have taken us into the fiscal danger zone in terms of long-term liabilities. Number 1, Social Security. Number 2, Medicare. And number 3, defense spending. Add to that a variable which holds a deadly surprise over the next several years, the 4th largest budget item today. That is, number 4, interest on the national debt. In brief, Social Security has a few trillion set aside for recipients, but is running a long-term $17.9 trillion deficit. Medicare requires $500 billion annually from the budget and is underfunded by a mere $86.5 trillion. Combining those two along with our current debts, we're in the red to the tune of $121 trillion. The current liabilities are the critical variable that could sink us long before structural reforms for Social Security and Medicare can be implemented. Consider the interest we're paying on current national debt. The Congressional Budget Office shows our current interest payments are $30 billion a month, or $360 billion a year. For perspective, that's roughly equivalent to what our interest payments were 15 years ago. The miracle is that we have 3.2 times the amount of debt today as we did then. It's grown from 5 trillion to over 16 trillion. That miracle is really the Fed's success in manipulating interest rates. All things being equal, and rates returning to normalized levels, interest on the national debt would or should be over $1 trillion today. That's $90 billion a month, or 42% of the current tax revenues. If it wasn't for the Fed's levitation of bond prices, that is yield suppression, we would be in more dire straits than any country in Europe. And that is coming. Like the other 3 areas that represent out-of-control promises and spending, this 4th is the one that represents an existential threat to the U.S. financial system. and the dollar as well. The Fed cannot control the bond market indefinitely. At present, they're responsible for the purchase of 90% of Treasury bonds. The Fed's balance sheet at greater than 50-to-1 leverage is now so exposed, a fluctuation in bond prices of just 2% would bankrupt them. Now, the Fed ordinarily pays back the interest it receives from Treasuries on its balance sheet to the Treasury Department. That changed in 2010, and now, as an extra cushion, the Fed keeps the cash and sets up an IOU with the Treasury Department. Yes, they're in need of that additional cash cushion. What can we expect in 2013 and perhaps the next 4 years? Pollster Scott Rasmussen sums it up well, saying the political class dreams of even more power, authority, and money flowing into Washington. That is why our nation's fiscal crisis is at its core a political crisis. The next 4 years is likely to accelerate Washington's power grab. We're not yet at the Alexander Tyler stage of dictatorship. The public is still in the discovery process, relishing the easy side of dependency on the state, even as a shrinking middle class makes the transition to being wards of the state. The midterms will tell a lot as to the White House consolidation of power around its dependents. The 2013 to 2016 business environment should look a lot more like the late 1940s, where government controls scared away private capital. Private treasuries stayed locked tight, trying to wait out the regulatory and tax insanity of the command economy period. Yesterday's Beijing, that is a command economy, has really come to Washington. Politics, we expect to see more of the same, with a divided legislature and a Democratic White House. Really, a repeat of the last 4 years is inevitable, with a frustrated White House using even more executive orders and signing statements to accomplish whatever their agenda may be. Politics at the popular level has and will continue to polarize. Right and left will be clearer to discern, with that move to the moderate middle being unacceptable to either party faithful. If status quo politics is the best we can hope for, what are the implications for the markets? Gold, equities, the bond market. Gold will continue to see a migration of frustrated investors dealing with the Fed's interest rate manipulation. They've used QE, Operation Twist, and an extended version to keep rates below a natural level. Cash on the one hand will be necessary, but dollars will be more and more suspect as time goes on. Central banks of the 1960s practiced a first mover advantage, getting to gold long before the general public did. Central banks will continue in that same effort today, diversifying away from dollars as a reserve asset. The Chinese goal from 2008 of 4,000 tons of gold will continue on track, with every price pullback representing an opportunity to buy without moving the market. Suffice it to say, the 12-year gold bull market, after taking a normal step back, will be at new highs in 2013, with silver following. The combination of investor demand and central bank demand are the critical variables in what is a fairly supply-constrained area. Stocks? Well, a repeat of 2012 is unlikely. Earnings, we believe, have peaked, and a combination of easy money policies and several years of cost-cutting have given corporations a temporary boost. Global economy is not on the mend. Following a first-quarter rally in China, the trend of slowing growth should continue globally. The U.S. is entering the first year of the presidential cycle, which is never as good as the fourth, where lots of government spending is sandbagged heading into the election. So for the bulls, we suggest caution and a raising of cash. Wind is not behind you. The bond market continues to defy logic and gravity. This is likely to remain the case until the forces of the market overwhelm the forces of central bank interventionism. 31-year bond bull market is over. What we're witnessing today is the Fed suspending market reality a bit longer. The market's demand for liquid assets, in this case treasuries, is without regard for the assets being of or from a solvent institution. We are not solvent. The market isn't looking at that today. When they do, there'll be a correction in price and an increase in interest rates, likely a 2014 to 2015 event. The bond market today is fraught with danger, and it's not surprising that the general public has been moving into that space, an area that, relatively speaking, holds more risk than virtually any other asset. Within the decade, we're likely to hear government bonds referred to again, as they were decades ago, as certificates of confiscation. What do we do now? Politically, appraise what level of involvement you've had in the political arena, and recognize, as C.S. Lewis said, that the reason we need good philosophers is because there are a lot of bad ones. The reason we need good statesmen is because we have a lot of bad politicians posing as statesmen. Recognize that lasting change has nothing to do with an election or with a single political personality. We are witness to an ideological shift that spans 40 to 50 years, wherein the significance of the individual citizen has been eclipsed by the importance of a political monster. The class of individuals controlling that monster, the American political class, protects it as both their livelihood and significance are derived from it. Now, government grows because bureaucrats like job security too. We just have to let them know that by prioritizing their job security, they may well be jeopardizing ours, and that's not acceptable. Any commitment to changing the fabric of society, for better or worse, is a long-term covenant. The mirror opposite of what has devolved over the last 40 to 50 years. Just like a legal contract, a covenant is a binding issue through time, not influenced or changed by circumstance. The Republic is an ideal which has to be fleshed out in reality. That does not happen spontaneously. There's a combination of intention, commitment, and investment in that sort of ideal. If you haven't invested in our Republic, then you can start by owning a part of the responsibility for what we have instead today, a decaying democracy, deteriorating as they all do. If you've delegated your interest in the public arena or your responsibility to others, you can't blame them, but you can hold them accountable, or you can quit delegating. In terms of financial strategy, we've shared our more specific advice in our films on Europe and Asia. Please take the time to study those. We hold to those specific recommendations and believe they carry value well into 2013 and beyond. For those who are unfamiliar with our general framework, let's quickly review what we call the perspective triangle. Draw out on the back of a napkin a simple triangle. This is simply a way of organizing your liquid assets to achieve specific purposes. Recognize that Wall Street embraces complexity not because investing is that complex, but because complexity promotes dependency, and confusion plays into reliance on highly skilled professionals. By contrast, we like the triangle as a simple reference tool for the three primary goals for your liquid assets. Remember, mandates are not specific investment vehicles, but the triangle cuts through the complexity and leaves you with clear strategic choices when you look at your savings, retirement, and investment assets. On the right side is perhaps the most mundane, but still vital, what we call liquidity, or the various cash alternatives with which you can manage a household, a business, or even opportunistically use to invest when a real value comes along. Liquidity is key. The downside of cash is that today it's actively managed by a group of self-proclaimed geniuses at the Fed, and they're at present managing cash balances into the ground. So we move to the base of the triangle for an offset to those inflationary trends. What we call insurance is not an insurance product, but rather, again, the purpose of the asset in the category. If the Fed is destroying your purchasing power, how do you insure against an almost certain outcome? Gold and silver provide such a protection and should be used as an offset to both currency investments and as a balance to the volatility of your more traditional investment classes like stocks and bonds. The last side of the triangle is designated for growth and income. Again, the mandate is general, and that's our primary concern. The specific investments should be compatible with that purpose served, growth and income, but typically they do comprise a well-managed portfolio of stocks and bonds. So how would we allocate today? Well, in rough terms, a target of 1/3 in each category is advisable. You hedge out the negative outcomes of inflation and deflation and any further market downside in terms of equities or bonds, as well as giving a portfolio a real potent exposure to a growth thematic in the event that we're surprised by a quick return to market normalcy in a growing economy. Unlikely, but still, that balance is helpful. Perhaps least understood is the insurance mandate. Gold and silver are in a growth phase. They have been for 12 years and are likely to be for many more. Metals allocations should consist of physical gold and silver, approximately 1/2 to 2/3 gold, with the remainder being silver. When purchasing metals today, you should consider whether or not you want a static or a dynamic investment. Static investment should favor bullion products like your generic state-minted coins or bars with established hallmarks. Silver bags, the old dimes and quarters and even silver dollars, are a great approach to silver. A dynamic portfolio, which can grow even in a down market, can be explored and constructed with the help of our advisors. Utilizing IRA assets for precious metals purchases is brilliant. You're safeguarding your retirement prospects with a reliable store of value and positioning yourself to keep all of the gains from growth in gold and silver, even as our tax structure is radically altering for the worse. In addition to IRA assets, I would aggressively position metals outside the United States. Central planners never learn the lessons of history, that more pressure does not net greater results. I hope I'm wrong, but you may someday need your cross-border holdings as seed capital to begin again. So strongly consider both our Toronto and Zurich venues. Lastly, you should carefully consider the wisdom of selling too soon. In other words, don't wait for the perfect price. Please don't sell your metals today, but keep in close touch with our company as prices go through a blow-off phase. As bull markets tend to do, you won't want to sell the day when everyone else gets the idea to do the very same thing. Our price projections remain consistent with what we said about 5 years ago. Gold has a high probability of reaching $5,000 an ounce. Silver, as much as $250 to $275. The best liquidity in any market is in a rapidly rising market. Remember that, and don't neglect the expertise of our advisors, all with an average of more than 2 decades in the business. Now, this reduction strategy raises the question of what's next. McAlvany Wealth Management, our wealth management company, was designed to serve that role. We manage assets conservatively with an awareness and appreciation of long-term trends, as well as the vital details for bottom-up security selection. Our goal is to grow assets ahead of the real rate of inflation. Start preparing the way today. Talk with your advisor at ICA about a future reduction strategy from a growing metals portfolio. And if your paper assets are being managed by a group that doesn't share your fiscal, economic, and political concerns, consider the McAlvany Wealth Management team as an alternative. Between our two companies, we combine the best coordination of offensive and defensive wealth management strategies. Time passes quickly, and so it's essential to think in terms of long-term strategies, be they political or financial. We live in an age of angry birds and not of chess, where your rewards are instant and there's only one move to make directly ahead of you, not, say, 10, 20, or 30 moves ahead. Not many think intergenerationally, and thus we find investors lost today in a confusion of noise and meaningless volumes of media drivel. Common is the class of investors that never learned the most powerful element in investing, that of patience. The key to growth being a time frame which encompasses the major shifts in asset classes from one long period to another. We find fiscal disasters looming because others, too, have failed to consider future implications for choices in the here and now. Strategic thinking is simply limited. As you pass into the new year, consider a new mode of operation where all of your actions and preferences are weighed in the light of history. Connect your beliefs to your behaviors. Actions that will, in time, leave a different legacy than the one we are now collectively passing on. Recall Alexander Tyler's assessment of the long historical cycle of freedom. And remember that the closer we are to dependency and bondage, the closer we are to spiritual faith and great courage. The cycle starts all over again.